I'm Dr. Mrinalini and I'm here to deliver an introductory session for behavioral finance. The rapidly growing field of behavioral finance uses insights from psychology to understand how human behavior influences the decisions of individual and professional investors, marketers, and managers. We are all human, which means that our behavior is influenced by psychology. Some decisions are very simple, day-to-day choices, such as how hard we are going to study for the next test or what brand of soda we are going to buy. But others significantly impact our financial well-being, such as whether we should buy a particular stock or how we should allocate our money among various investment funds. The purpose of this lecture is to present what we have learned about financial decision-making from behavioral finance research, while recognizing the challenges that remain. By reviewing the foundations of modern finance and its inability to account for various paradoxes and anomalies, and the genesis of behavioral finance as reflected in prospect theory and the limits to arbitrage perspective. Expected utility theory is an axiomatic, normative model that demonstrates how people should behave when facing decisions involving risk. In comparing prospects, which are simply probability distributions of final wealth levels, the basic procedure is to assign a utility level to each possible wealth outcome. Weight each utility value by the associated probability and choose the prospect with the highest expected utility. Although expected utility theory has been very useful in modeling individual decision-making, financial theorists required a paradigm to describe how investors evaluated risk and determined prices in markets. Similarly, mean variance analysis and the CAPM model were central developments, providing for the first time guidance on how risk should be measured and risky assets priced. At around the same time, the notion of market efficiency became prominent. Market efficiency is inextricably linked to asset pricing models because of the joint hypothesis problem. The fact that tests of market efficiency also require the use of a particular risk adjustment mechanism. Let's talk about behavioral finance now. So behavioral finance is an area of study focused on how psychological influences can affect market outcomes. It is a subfield of behavioral economics, which proposes that psychological influences and biases affect the financial behaviors of investors and financial practitioners. Behavioral finance can be analyzed from a variety of perspectives. Stock market returns are one area of finance where psychological behaviors are often assumed to influence market outcomes and returns. But there are also many different angles for observation. The purpose of the classification of behavioral finance is to help understand why people make certain financial choices and how those choices can affect markets. Within behavioral finance, it is assumed that financial participants are not perfectly rational and self-controlled, but rather psychologically influential with somewhat normal and self-controlling tendencies. Some basic tenets of the traditional finance theory, they talk about, number one, the people have rational preferences across possible outcomes or states of nature. The second one, people maximize utility and firms maximize profits. Third, people make independent decisions based on all relevant information available in the markets. Behavioral finance in stock market, the efficient market hypothesis says that any given time in a highly liquid market, stock prices are efficiently valued to reflect all the available information. However, many studies have documented the long-term historical phenomena in securities markets that contradict the efficient market hypothesis and cannot be captured plausibly in models based on perfect investor rationality. The EMH is generally based on the belief that market participants view stock prices rationally, based on all current and future intrinsic and external factors. When studying the stock market, behavioral finance takes the view that markets are not fully efficient. Now, this allows for the observation of how psychological and social factors can influence the buying and selling of stocks. Further, the understanding and usage of behavioral finance biases can be applied to stock and other trading market movements on a daily basis. Broadly, behavioral finance theories have also been used to provide clearer explanations of substantial market anomalies like market bubbles and deep recessions. While not a part of EMH, investors and portfolio managers have a vested interest in understanding behavioral finance trends. These trends can be used to help analyze market price levels and fluctuations for speculation as well as decision-making purposes. The EMH does not assume that all investors are rational, but it does assume that markets make unbiased forecasts of the future. In contrast, the behavioral finance assumes that financial markets are informationally inefficient. Specific applications of behavioral finance can be examined in phenomena like inflation and the underpricing of the IPOs. Behavioral finance theory holds that markets might fail to reflect economic fundamentals under conditions of irrational behavior, systematic patterns of behavior, and limits to arbitrage in financial markets. Investors behave irrationally when they don't correctly process all the available information while forming their expectations of a company's future. When large group of investors share particular patterns of behavior, that is the irrational systematic behavior, persistent price deviations do occur. So the behavioral finance theory suggests that the patterns of overconfidence, overreaction, and over-representation are common to many investors, and such groups can be large enough to prevent a company's share price from reflecting economic fundamentals. Let's talk about one of the most used traditional finance theory, which is expected utility theory. It means individuals should act when confronted with decision making under uncertainty in a certain way. Now, theory is really set up to deal with risk and not uncertainty. However, the financial markets are all about uncertainty. Risk is when you know what the outcomes could be and can assign probabilities, while uncertainty is when you can't assign probabilities or you can't come up with a list of possible outcomes. Now, the offshoot is the prospect theory from the behavioral finance that helps to understand and complement expected utility theory. Prospect theory was developed by Daniel Kahneman and Amos Tversky based on observing actual behavior. Prospect theory begins with the contention that standard expected utility theory cannot fully account for observed decision making under risk. This contention is based on empirical evidence that people often behave contrary to expected utility theory. A prospect is defined as a series of wealth or income levels and associated probabilities. Following problems may illustrate the three key aspects and the key tenets of the prospect theory. Let's see. Imagine that you face the following pair of concurrent decisions. First, examine both decisions and then indicate the options you prefer. Maybe you can take a mental note of it. Decision 1. Choose between prospect 1, which is a sure shot gain of $240, and prospect 2, which is a probability of 25% to gain $1,000. Second concurrent decision is a decision 2, which is choose between prospect 3, which is a sure shot loss of $750, and prospect 4, which gives you a probability of 75% of losing $1,000. Let's see. In other words, the first choice is between a sure gain of $240 and a 25% chance to gain $1,000. The second choice is between a sure loss of $750 and a 75% chance to lose $1,000. For problem 1, 84% of the respondents chose P1 in decision 1, which is consistent with risk aversion. Yet, 87% chose P4 in decision 2, which is consistent with risk seeking. Expected utility theory cannot incorporate changes in risk attitude like this. Prospect theory, however, allows for changes in risk attitude depending on the nature of the prospect. And therefore, we have our key aspect of the prospect theory, number 1, as people sometimes exhibit risk aversion and sometimes exhibit risk seeking, depending on the nature of the prospect. Researchers have also noticed that gains and losses seem to be what people care about rather than the level of wealth. Expected utility theory generally uses the level of wealth, not the changes in level of wealth, as the variable of importance in a utility function and allows for no boundary points between risk aversion and risk seeking. People are assumed to exhibit consistent risk preferences. Let's imagine another problem. Decision 1 speaks assume yourself richer by $300 than you are today. Then choose between prospect 5, which is a sure shot gain of $100, and prospect 6, which is a 50% probability of gaining $200. Another decision, assume yourself richer by $500 than you are today. Then choose between prospect 7, which is a sure shot loss of $100, and prospect 8, which is a 50% probability of losing $200. Let's see how the respondents react to it. Notice that the two decisions are effectively the same. In both cases, the decision is between $400 with certainty and a prospect with a 50% chance of $500 and a 50% chance of $300. Risk attitude is not the same across gains and losses, implying that it is the change in wealth rather than the level that matters to the people. People evaluate an outcome based on the gain or loss from a reference point, usually taken to be the current wealth. Expected utility theory assumes that people value outcomes based on the final wealth position, regardless of the person's initial wealth. This leads to the second key aspect of decision making and the second key aspect of the prospect theory, which is people's valuations of prospects depend on gains and losses relative to a reference point. This reference point is usually the status quo. Problem 3. What value of X would make you indifferent between prospect 9, which is 0, and prospect 10, which is 0.50 X and a loss of $25? Now P9 here is the status quo. The average response in this experiment was $61.6. That is, for a fair gamble, when the loss is $25, the typical person requires a gain of $61 to be indifferent between accepting or rejecting the gamble. It is quite clear that people are quite averse to a loss. Loss aversion is the term that describes the observation that for most people, losses loom larger than gains. Noting that risk neutrality implies X is equals to $25. The upside had to be more than 2 times the absolute value of the downside in order to induce indifference between the two prospects. And this brings us to the third key tenet of prospect theory, which is people are averse to losses because losses loom larger than gains. We have another contention to the expected utility theory, which is Eli paradox. This was given by Morris Eli in 1953. A number of observed behaviors that appear to be contrary to predictions generated by conventional finance model. Contradiction of expected utility theory, the so-called Eli paradox. The Eli paradox is a prospect choice problem. The paradox undermines the theory of expected utility because it shows that we don't always make choices that align with our wants and needs. We often tend to make decisions based on how much we think we have to gain or lose now, rather than on the final outcome. And we also tend to choose certainty over risk, even if the riskier option is closer to what we really want. Psychologists who have studied the Eli paradox found that people dislike risk in general. There's another effect which is being played, which is framing effect. Frames are very important. Essential condition for a theory of choice is principle of invariance. Different representations of the same problem should yield same preference. Unfortunately, this sometimes does not work out in practice. People have different perspectives and come up with different decisions depending on how a problem is framed. And perception and memory therefore are influenced by context or the frame. When items are temporarily sequential rather than first impressions dominating, a recency effect can instead be observed. In other words, what comes last has greater impact. This begs the question, is the primacy effect or the recency effect stronger? The answer seems to be that it depends. When events are separated by a non-trivial passage of time, recency generally dominates. For example, an event occurring last week will have more impact than one occurring last year. But the first of two related sequential events, one following on the heels of the other, example two political speeches, will often have greater impact. Behavioral finance have some key concepts underlying. These are mental accounting. Mental accounting refers to the propensity for people to allocate money for specific purposes. As we have seen, the framing of outcomes has an important impact on the decisions people make. Let us turn to an example of this in a riskless context. Answer the following yes or no question. Imagine that you have decided to see a play where admission is $10 per ticket. As you enter the theatre, you discover that you have lost a $10 bill. Would you still pay $10 for a ticket to the play? Now mentally note your response and then answer the next yes or no question. Imagine that you have decided to see a play and have paid the admission price of $10 per ticket. As you enter the theatre, you discover that you have lost the ticket. The seat was not marked and the ticket cannot be recovered. Would you still pay $10 for another ticket? Let's see how the respondents respond to this query. Of course, nothing is really different between the questions. A certain amount of money, which is $10, has been irretrievably lost. And the only decision you have to make is whether or not the theatre experience is worth $10 to you. Whether or not the $10 was lost in the form of cash or in the form of a theatre ticket is truly irrelevant. Do people see it this way? Many do not. Of course, the respondents give the first question, 88% said that they would buy a ticket. Yet, of the respondents given the second version of the question, the majority reacted, that is 54% said that they would not buy a ticket. Now, why different answers? The difference in the responses is due to mental accounting. Mental accounting is one method people use to make decision-making manageable. According to Nobel laureate Richard Taylor, mental accounting is the set of cognitive operations used by individuals and households to organize, evaluate, and keep track of financial activities. Key components of mental accounting are account assignment, closure, and evaluation. Consider what sorts of accounts may exist. Many people nominally place their monies in silos. Expenditures, that is food, housing, entertainment, vacation. Wealth, which is checking account, retirement savings, and income, which is salary and bonus. It is important to note that often these accounts are mental constructs rather than actual accounts. For example, most of us have not explicitly set up a bank account or a piggy bank for entertainment. Some other key concepts relating to behavioral finance are herd behavior. Herd behavior states that people tend to mimic the financial behaviors of the majority of the herd. Herding is notorious in the stock market as the cause behind dramatic rallies and sell-offs. Emotional gap. The emotional gap refers to decision making based on extreme emotions or emotional strains such as anxiety, anger, fear, greed, or excitement. Oftentimes, emotions are a key reason why people do not make rational choices. Anchoring. Anchoring refers to attaching a spending level to a certain reference. Examples may include spending inconsistently based on a budget level or rationalizing spending based on different satisfaction utilities. Self-attribution. Self-attribution refers to a tendency to make choices based on a confidence in self-based knowledge. Self-attribution usually stems from intrinsic confidence of a particular area. With this category, individuals tend to rank their knowledge higher than others. Now, breaking down the biases further, many individual biases and tendencies have been identified for behavioral finance analysis, and those include disposition bias. Disposition bias refers to when investors sell their winners and hang on to their losers. Investors' thinking is that they want to realize gains quickly. However, when an investment is losing money, they will hold on to it because they want to get back to even or their initial price. So, the biases in behavioral finance talk about investors tend to admit they're correct about an investment quickly, which there is a gain. However, investors are reluctant to admit when they made an investment mistake, when there is a loss. The flaw in disposition bias is that the performance of the investment is often tied to the entry price for the investor. In other words, investors gauge the performance of their investment based on their individual entry price, disregarding fundamentals or attributes of the investment that may have changed. Summarizing, we will feel that biases in the behavioral finance, in the psychology, they play a very important role in financial decision making as well. Let's talk about the confirmation bias now. Confirmation bias is when investors have a bias toward accepting information that confirms their already held belief in an investment. If information services, investors accept it readily to confirm that they are correct about their investment decision, even if the information is flawed. There's another bias, which is experiential bias. An experiential bias occurs when investors' memory of recent events make them biased or leads them to believe that the event is far more likely to occur again. For example, the financial crisis in 2008 and 2009 led many investors to exit the stock markets. The main theory in behavioral finance, which I've also talked about in the prospect theory, one of the key tenets of prospect theory talks about that losses loom larger than gains. It comes from loss aversion. Loss aversion occurs when investors place a greater weighting on the concern for losses than the pleasure from market gains. In other words, they are far more likely to try to assign a higher priority on avoiding losses than making investment gains. As a result, some investors might want a higher payout to compensate for losses. If the high payout isn't likely, they might try to avoid losses altogether, even if the investment's risk is acceptable from a rational standpoint. I conclude here by saying thank you.